Hi, this is Wes Johnson with Act Advisors here with your March 2023 market update. Doug English usually does these recordings, but he's traveling right now, so you guys get me. And for those of you who are not familiar with me, I am based out of our Charleston, South Carolina office. So let's get into it. March was a wild ride. The first week of March started out normal, calm, the market's going in the right direction. And then we all get introduced to Silicon Valley Bank and the regional banking crisis. So subsequently, the markets experienced extreme volatility for the next couple of weeks. But the good news is the central banks, including Switzerland, because they had a situation over there as well, the central bank stepped in and basically said, we're going to do whatever we have to do to control this. And they did. And eventually the knee-jerk reaction settled down, the panic went away, and by the last week of March, things were moving back in the right direction. But we did experience some extreme volatility for a couple of weeks there. But when you look at the final numbers for March, they ended up pretty good. The bond market was up about 2.5%. That's a little misleading. There were several areas of the bond market that were disproportionately punished during the financial crisis, the regional bank crisis. Those are recovering, but they really suffered some serious losses for those couple of weeks. The stock market, when you look at the S&P 500, it was up 3.5% for the month. 3.5% is a really good number for 1 month. But again, that's a little misleading as well. If you look at mid-cap stocks, they lost 3% for the month. Small cap stocks lost 5% for the month. And those regional banking names usually fall in the mid-cap and the small cap indexes. So, but by the end of the month, mid caps, small caps, everything was moving back in the right direction. The stock and the bond rotation strategies that we manage for you guys, that's part of the investment management that we do. Those strategies are meant to rotate what we're investing in each month based on the areas of the stock and the bond market that are exhibiting the most upward momentum. So for the stock rotation strategy, we moved out of mid-cap stocks and into the NASDAQ. The NASDAQ is a very tech-heavy index. We use QQQ as our position for that, or we call it the Qs. The bond rotation strategy, we typically hold 3 positions, the 3 areas of the bond market that have the highest momentum. One of those positions changed over, 2 of them stayed the same. So we swapped out of floating rate bonds and into long-term treasury bonds. The 2 positions that stayed the same were convertibles and preferreds. So again, those rotation strategies, they rotate every month based on which areas of the stock or the bond markets are exhibiting the most upward momentum. So to kind of summarize, March was a wild ride. We could look at a very glass half full perspective on the regional banking crisis. Virtually every bank on the planet did not get caught up in this regional banking crisis. So these other banks that were fine were probably looking at what was going on, and they're getting more conservative now. When they get more conservative, they lend less, and when there's less lending, that means less economic growth for the rest of the economy. That's exactly what the Fed is trying to accomplish right now with their interest rate hikes. So interest rate hikes are meant to slow down the economy to get inflation under control. The regional banking crisis we just saw last month may help them get to that point to where they get inflation under control. That may mean the Fed can stop hiking rates sooner. We'll see if that actually pans out. But thank you for going on that wild ride with us in March. And as always, thank you for your business.